Yeah, morning traders. A fairly lively trading session on the day. And as we look forward, it should continue to be so. I mean, we've obviously got UK CPI in the session ahead. We've got the Fed meeting, which is really all about the dots. That's what the algos are going to be keying off initially, but that's something that we obviously need to navigate our portfolios through. It's obviously an event risk that we need to be cognizant of. But our opening calls for Asia at the moment are looking quite constructive. We do see the Nikkei opening another 53 points higher. So building on that, the break of 40,000 that we've been seeing. Can we sort of push into those recent highs and take them out? Something we're going to be seeing. Certainly momentum favouring the bold at the moment. And the Hang Seng, we're expecting to see a slightly better reprieve there. We're calling the market up about 50 basis points, and the ASX currently opening call at the moment 77.16, up about 20 basis points. But of course, it's really all been about the Bank of Japan. A lot of the measures that we saw were speculated on very, very heavily in the press. The market's sort of seen what it wanted to hear, but we have seen a kind of buy the rumour, sell the fact playing out in the Japanese yen. We have seen dollar yen trade up to 150.96, just shy of the figure. I think we are testing that sort of recent consolidation highs. If we break through these levels, then I think obviously we sort of target 151.90, which was the 13th of November highs that we've been seeing. Obviously, we are running into slightly hotter intervention risk. I know any kind of currency intervention is done by the Ministry of Finance, but the Bank of Japan, also Oeda, talked about this in his press conference and mentioned the weakness in the yen, how it could affect policy going forward. And in some ways, at the margin, further weakness does sort of propel, bring forward rate hikes coming through as well. But certainly the yen has been sold off. And I think part of this is down to the moves that we've been seeing in the JGB market. We did see 10-year rates moving down about 3 or 4 basis points, and 10-year real rates in Japan now are sitting at negative 51 basis points, so down about 4 basis points. So I think the fact that we saw buyers coming through in the JGB market just incentivises people to go out and sell yen in that situation, certainly against the Noki, where we saw a big move playing through. If we have a look at Japan rates at the moment, we do see about 27 basis points of cuts of hikes being priced in by the end of the year. So not a huge move there. The market's still not getting particularly excited about what we've been seeing, but certainly the yen being sold off. But we are coming back into intervention territory going forward. We are still watching the data flow. I think we are going to be sort of heightened alert. There's still further wage negotiations to still come through from various parts of the unions. And we do see national CPI at the end of the week. So obviously something that we are going to be watching closely there as well. Aussie dollar's been well traded. We have seen that have a reasonable move, certainly more than what the options market were implying. We saw the Aussie dollar trade 66.60 down to the lows of the session of 65.04. So some of the cyclical currencies getting reasonably beaten up overnight as that dollar strength manifested. We have seen a bit of a bounce, I think, as some of the risk came back on, and we've seen some gains coming through in US equity markets, but we're currently trading at 66.32, as I say. So off the lows of just testing the figure on the session there as well. If you have a look at Aussie rates in the back of what we saw from the RBA yesterday, and of course everyone was taking out this slight change in nuance where the RBA have said that hikes cannot be ruled out, and they've changed that to broadly not ruling anything out, in or out. And that slight tweak, obviously was part of the reason we saw the Aussie dollar fall. But we've got about 19 basis points of cuts priced for August. We've got 26 being priced for September. So that August-September window is kind of the live point, and we've got about 43 basis points or nearly 2 cuts being priced in by the end of the year in that situation. Obviously, all eyes on the employment number tomorrow, see if we get any kind of movement playing through there as well. In terms of equity markets, well, you can see that European equity markets have had some reasonable gains. Certainly, we've seen the Spanish IBEX push to new all-time highs, something we are watching. In the US, we have seen about 60 basis point gain in the S&P, so new closing highs coming through there as well. Volumes were about 12% below the 30-day average, but we're looking about sort of 1.3 million SPOs traded hands, where we've seen a record coming through in the futures market there as well. If we go into the sectors, well, you can see that energies work well. You are continuing to see a stronger crude price playing through, up about 90 basis points there. We're right into the top end of that sort of bull channel that we've been seeing there. But energy's working well. Utilities, discretionary, tech and financials are holding in quite well, putting in some gains. And we've seen Nvidia pushing up 1.1%. So certainly not the fireworks some people are expecting from the GTC conference, but obviously that is priced very well indeed, and the expectations for GTC are obviously very high. So the fact that we chalked out a gain is a small win, I suppose, for the bulls coming through. So those leads are going to manifest in a slightly stronger open for Asian markets. As I say, it is all about UK CPI tonight. Obviously, watch those sterling exposures. We are expecting headline to drop a little bit from 4% to say 3.5%, and core to drop to 4.6%. But really for the session ahead, it's really going to be about the Fed statement. Is there going to be any kind of changes to their economic projections. Are we going to see a slight upgrade from 1.4% GDP for this year into, say, 1.8%? But then it's going to be about the dot plot projections, effectively. We've got 6 members at the moment who are sitting on that sort of call for 3 rate cuts at 4.625% for the end of the year Fed funds. Will any of those members move their dot higher? I think there's going to be a lot of pressure on them about the impact that they would do if we were to see the median dots move up. But if we were to see 2 rate cuts being priced in as opposed to 3 from the dots, you could see markets coming alive with some dollar strength and a bit of a spike up in yields. Conversely, there's a good chance they could keep them as they are, and I think maybe with some further relief. And I think the way equities have been trading overnight suggests that the market is probably saying that we're leaning on that camp as well. So some big moves to trade and a lot coming up in the session ahead.